There are 4 accounts that millions of Americans over the age of 65 are still putting money into, right now, that are quietly being taxed twice by the federal government. 4 accounts. And I need to stop you right there before you assume this is not about you, because that assumption is exactly what keeps costing people thousands of dollars every single year. Here is what I already know you are thinking. You are thinking one of 2 things. Either you are thinking this is only for seniors who are bad with money, the disorganized ones, the ones who never paid attention to their finances. So if you have been reasonably careful your whole life, you are already tuning out. Or you are thinking this is some complicated high-income tax shelter thing. So if you are living mostly on Social Security and a modest pension, you are already thinking this one is not for me. Both of those are completely wrong, and I want to be direct with you right now. This list applies to both of you. Whether your entire retirement income is a Social Security check and a small pension, or you have got a healthy IRA, a brokerage account, and a home that has doubled in value, there is real money being lost on this list with your name on it. For some of these accounts, the damage is worst for the lower-income retiree. For others, the damage hits hardest at the comfortable middle-class senior. I am going to tell you on every single one exactly which group is getting hurt, and how, so that nobody watching can say this does not apply to me. Because the honest truth is this: the IRS does not care how careful you have been your entire life. Double taxation does not only happen to careless people, it happens to careful, responsible seniors at every income level, just in different ways, and through different accounts. The reason almost nobody warns you about these 4 accounts is the same reason it is always the same. Every institution that benefits from you keeping money in the wrong place has a financial incentive to stay quiet. Your bank does not call to tell you that the account you have been faithfully contributing to is creating a tax problem. Your HR department did not warn you when you were 52 that the account you were maxing out every year was going to create a forced withdrawal problem at 73. And the brokerage statement that arrives every January showing your gains does not come with a note explaining that you just triggered a tax on your Social Security check in the process. In the next 20 minutes, I am going to walk you through all 4 of these accounts one at a time in plain English. I am going to show you exactly how the double taxation works, which group it hits hardest, and most importantly, what you can do right now to stop it or reverse it. And then I am going to give you 3 bonus moves at the end specifically for the retiree who has already built up serious money, because those 3 moves can undo years of damage quietly and legally, and almost no one in your position is using them. Here is the one idea that ties everything together before we start. Double taxation does not announce itself. There is no letter. There is no notice. There is no penalty that signals something is wrong. The money just quietly leaves your account every year in 2 separate directions, and most people never connect the 2 events because they happen months apart. That is the most expensive kind of loss there is. The invisible kind. My name is Nolan Graves. I am an enrolled agent, which means I am federally licensed to represent taxpayers directly in front of the Internal Revenue Service. Not just prepare returns. Actually stand between you and the IRS and fight on your behalf. And the most painful thing I see in my work is not people who made reckless decisions. It is careful, responsible seniors in their late 60s and 70s who did everything they were told to do, saved faithfully, put money away every year, and are now quietly paying a tax penalty for doing the right thing, because nobody ever explained what happens to those accounts on the other side of retirement. That is what this video is about. 4 accounts. Let us start with the most common one. Account number 1 is your traditional IRA, or your traditional 401k. And I want to be very careful here because this is the one that is going to make some of you genuinely angry when you understand what has been happening. Here is how the double taxation works on this one. When you were working, you put money into a traditional IRA or 401k before taxes. That was the deal. Defer the tax now. Pay it later in retirement when your income would be lower. That part most people understand. Here is the part most people do not understand. The IRS has a rule called the required minimum distribution. Once you turn 73, the government forces you to pull a specific amount out of that account every single year, whether you need the money or not. That withdrawal is counted as ordinary income. It goes on your tax return just like a paycheck. You pay income tax on it. That is tax number 1 on that money. Now here is where tax number 2 comes in, and this is the one that blindsides people completely. That forced withdrawal does not just get taxed by itself. It gets added to everything else you earn. Your Social Security, your pension, your investment income, and when that total crosses a certain threshold, the IRS starts taxing up to 85% of your Social Security benefits. So your traditional IRA forces out income. That income pushes your Social Security over the threshold, and now your Social Security gets taxed too. 2 separate taxes triggered by the same account. The IRS collected from the IRA withdrawal and from the Social Security benefit that the withdrawal pushed into taxable territory. That is the double taxation. And it is completely legal. And it is happening to millions of seniors right now who have no idea the 2 events are connected. Here is who this hits hardest, and it is both groups. If you are a lower income senior and most of your income is Social Security, even a modest IRA withdrawal can push you over the threshold where your benefits start getting taxed. You did the right thing. You saved a little extra, and the reward is a tax on money you thought was tax-free. If you are a comfortable retiree with a large traditional IRA, the required minimum distributions can be enormous. Tens of thousands of dollars forced out every year, pushing 85% of your Social Security into full taxation, potentially bumping you into a higher bracket entirely. Here is the mistake that hits everyone regardless of income level. People keep contributing to or rolling money into traditional IRAs in retirement because that is what they have always done. It is habit. And every dollar added to that account today is another dollar that will be forced out later at whatever tax rate exists then, and another dollar that could push more of your Social Security into taxable territory. Here is the exact fix. First, if you are under 73, you have a window. Work with an enrolled agent or a qualified tax professional to model out your future required minimum distributions. See what your forced income will look like at 73, 75, 80. If it is going to push your Social Security into heavy taxation, you may want to convert some of that traditional IRA to a Roth IRA now in years when your income is lower. Pay a smaller tax today to avoid a larger double tax later. Second, if you are already taking required minimum distributions, do not take them in January out of pure habit. Talk to a professional about the timing and whether a qualified charitable distribution can satisfy part of that withdrawal requirement with zero tax. Do not keep feeding an account that is going to charge you twice on the way out. That is account number 1. Account number 2 is one that feels completely safe. It feels responsible. It feels like exactly what a careful senior should be doing. And that is precisely why it catches so many people off guard. Account number 2 is your high-yield savings account or your certificate of deposit. Here is how the double taxation works on this one. Interest income from a savings account or a CD is taxed as ordinary income. Every dollar of interest your bank pays you gets reported on a 1099-INT and goes straight onto your tax return. You pay income tax on it at your regular rate. That is tax number 1. Now here is tax number 2. That interest income gets added to your total income for the year. And when your total income crosses the Social Security taxation thresholds, $25,000 for a single filer and $32,000 for a married couple, up to 85% of your Social Security benefit becomes taxable income. So your savings account pays you interest. The IRS taxes that interest directly. Then that same interest income pushes your Social Security over the threshold. And now your Social Security gets taxed too. The bank paid you $4,000 in interest. You paid tax on the $4,000. And that $4,000 also made $3,400 worth of your Social Security taxable. Two tax events. One source. Here is who this hits hardest, and it is a different split this time. This one hits the careful, responsible, middle-income senior the hardest. Not the wealthy one with a financial advisor structuring everything. Not the low-income senior with almost no savings. The person it destroys is the one who did exactly what every financial article told them to do for the last 40 years. Build an emergency fund. Keep cash safe. Put it in a CD. And in today's environment, with rates finally above 2%, the interest is real money. Real money that is creating a real double tax problem. The lower-income senior is not immune either. If you are close to the Social Security threshold, even a small interest payment can tip you over. And once you cross that line, the tax does not just apply to the interest. It applies to a portion of every Social Security dollar you receive. Here is the mistake that hits everyone. People move money into high-yield savings accounts and CDs because it feels conservative and safe. And it is safe from market risk. It is not safe from tax risk. And most people never think about their savings account as a tax liability. The lower-income senior is less likely to have a large brokerage account, but if you have any dividend income at all and you are near the threshold, even a few $100s of dividends can be the thing that tips you over. Here is the mistake that hits everyone. People look at their brokerage account statement, see that their portfolio generated $6,000 in dividends this year, and feel good. Income is income. What they do not see is the second line item, the one that shows how much of their Social Security just became taxable because of those dividends. Here is the exact fix. This is where the conversation about asset location becomes critical. Asset location means putting different types of investments in different types of accounts based on their tax treatment. Dividend-heavy funds belong inside tax-sheltered accounts like a Roth IRA, where the dividends accumulate without ever appearing on your tax return and never push your Social Security threshold higher. Lower dividend funds or growth funds that do not pay out regular income are more appropriate for taxable brokerage accounts. If you cannot move things immediately because of the tax cost of selling, this is a conversation to have with a professional about a multi-year transition plan. But the direction is clear. Stop letting automatic dividend income quietly erode your Social Security benefit year after year. That is account number 3. Account number 4 is the most invisible one on this list. And invisible losses are always the most expensive, because you cannot fix a problem you cannot see. Account number 4 is the money market account or cash position sitting inside your traditional IRA or 401k. Here is how the double taxation works on this one. When markets get volatile, many seniors move a portion of their retirement account into the money market or cash option inside the plan. It feels safe. It feels smart. The money is still inside the IRA, so it still grows tax-deferred. But here is what almost no one thinks about. That cash position is still going to come out as a required minimum distribution eventually. It is still going to be counted as ordinary income. It is still going to push your Social Security threshold higher. You did not escape the tax problem by moving to cash inside the account. You just delayed it. And here is where the second tax hits in a way that is unique to this account. The money market inside your IRA is earning a money market rate, maybe 4 or 5% right now. But that money is going to come out as ordinary income taxed at your full rate, not at the lower capital gains rate, not tax-free, full ordinary income rate. Here is the exact fix. The question to ask yourself is not, what interest rate am I earning? The question is, what is my after-tax interest rate, and what is the Social Security taxation cost on top of that? For some people, the answer points toward keeping less in taxable interest-bearing accounts and moving some of that safe money into a Roth IRA if they are still eligible to contribute, or into certain types of municipal bonds whose interest is federally tax-free and does not count toward the Social Security income threshold. I am not telling you to chase risk. I am telling you to stop assuming that a safe account means a tax-efficient account. Those are two completely different things. That is account number 2. Account number 3 is going to surprise people because it is one of the accounts that financial media tells you is a sign that you have done well. A taxable brokerage account with dividend-paying stocks or mutual funds. Here is how the double taxation works on this one. When your brokerage account holds dividend-paying stocks or funds, those dividends are paid out to you automatically. You did not sell anything. You did not make a decision. The company just sent you money, and that money shows up on a 1099-DIV at tax time. Qualified dividends are taxed at the capital gains rate, which for many retirees is 15%. That is tax number 1. Now here is tax number 2. Those dividends, every single dollar of them, get added to your total income for the year. And that income is what the IRS uses to determine how much of your Social Security is taxable, even if you did not spend the dividends, even if they were automatically reinvested back into the fund. They still count as income. They still push your Social Security closer to or over the threshold. So the brokerage account generates dividends. You pay tax on the dividends. The dividends then push your Social Security into taxable territory. You pay tax on that too. 2 taxes, 1 account. And the second tax was triggered by income you may not have even touched. Here is who this hits hardest. This one lands squarely on the comfortable retiree who has done well. If you have a meaningful brokerage account generating several $1,000s a year in dividends, there is a very real chance that income is the thing pushing your Social Security from partially taxable to 85% taxable. And the difference between 50% of your benefit being taxed versus 85% being taxed on a $24,000 annual Social Security income is over $2,000 in additional federal tax every single year, year after year, invisibly. Compare that to money sitting in a Roth IRA earning the same money market rate. When that comes out, it comes out at 0% tax. The account types are paying the same interest rate. The tax treatment is completely different. One costs you potentially 22% on the way out. The other costs you nothing. That is the double penalty. You parked money in what felt like the safe, conservative option inside your retirement account. It grew slowly. And it is going to be taxed at the highest possible rate on exit, while simultaneously pushing your Social Security into taxable territory. Here is who this hits hardest. This one hits the cautious retiree hardest regardless of income level. The person who moved to cash during a market downturn and never moved back. The person who has 30 or 40% of their IRA sitting in the plan's money market fund right now because the market feels uncertain. You are not avoiding risk. You are trading market risk for tax risk, and tax risk does not recover when the market rebounds. Here is the exact fix. If you have cash sitting in a money market inside a traditional IRA, the question to ask is whether some or all of that cash should be in a Roth IRA instead, where the same conservative investment produces 0 taxable income and 0 impact on your Social Security threshold. That conversion has a tax cost today, but you compare that one-time cost to the ongoing double tax that cash will generate every year it stays where it is. This is not a decision to make alone, but it is absolutely a conversation to have before another required minimum distribution season arrives. That is account number 4. Now I promised you 3 bonus moves, and I want to be honest about who these are for. The 4 accounts I just covered apply to seniors at every income level. These last 3 are specifically for the retiree who has built up real money, a meaningful IRA balance, a brokerage account, assets that have grown. If that is not your situation, the first 4 already covered you, and the most important thing you can do is act on those. But if you have built something, these 3 moves can undo years of double taxation damage quietly and completely legally. And the videos that focus only on lower-income seniors never mention them because their audience cannot use them. You can. Let me bring all of this together with the one idea that matters more than any individual account I just described. The IRS does not send you a notice when it taxes you twice. There is no letter, no alert, no line on your statement that says double taxation applied here. The traditional IRA forces out income, and separately, your Social Security gets taxed. The savings account pays interest, and separately, that interest makes your Social Security taxable. The brokerage dividends hit your 1099, and separately, those same dividends push your benefits over the threshold. Two events, months apart, never labeled as connected. That is how it stays invisible for years. The four accounts are real. The double taxation is real. And every single year those accounts stay in the wrong configuration is another year the IRS collects twice. The Roth conversion window closes at 73. The qualified charitable distribution only works if the money is still in the IRA. The tax loss harvesting only works while the losses exist. None of this fixes itself. Nobody mails you a correction. The system stays exactly as it is unless you stand up and change it. Being aware of double taxation is not the same as stopping it. Knowing the rule exists is worthless until you act on it. 4 accounts, 3 bonus moves, every single one of them fixable, but not automatically.